Hi viewers, today we'll be talking about the 5 deadly sins of stock market investing. There are many ingredients in the recipe for investing, but by far one of the most important is patience. Warren Buffett, one of the most successful stock investors, said, "The stock market is a device for transferring money from the impatient to the patient." It's a mistake to treat the stock market like a casino or a get-rich-quick scheme. This goes both ways. Investors who are not patient enough to wait for the right opportunity and buy in too quickly, chasing whatever stock is rumored to do well. And investors who are not patient enough to wait out the fluctuations in the market and sell too quickly. For the first impatient investor, an investment technique that may help you to slow down is imagining that you're only allowed to invest in 20 stocks over the entire period of your life. When you're done investing in these stocks, you're not allowed to invest in any more stocks over your entire lifetime. Once you think like this, you'll pause before investing and ensure that this is a good stock that you're taking into your portfolio. For the second impatient investor, this is what many believe the stock market looks like, but in reality, this is what the stock market looks like. Whether or not you bought the stocks at low prices, long-term investors in good companies will almost always grow their wealth. The mistake here is to become impatient and sell out of good stocks too soon. In summary, practice patience when investing in stocks. Don't buy a share until you've received some professional advice or understood the company for yourself. And don't sell out too quickly because of fear due to the short-term fluctuations in the market. 2. Investing in penny stocks. This is one mistake that I can honestly say I almost made when I first joined the market. You'll hear marketing gimmicks saying, this stock is only 60 cents. If it rises by even 1 shilling, you'll have made more than 200% profit. And it sounds great, but what they don't tell you is that there's probably a reason that this stock has been priced at 60 cents. Maybe it's just a bad stock, and eventually that company could tank and you'd lose all your money. The temptation is to buy big volumes of this stock and hopefully make a lot of money in short periods of time, but it's also very risky. Avoid trading on gimmicks like this. Instead, understand the company that you're investing in, or if you have no idea how the market works, listen to an investment advisor. 3. Living in the past. This mistake involves investing in a stock based on its past performance. Investing in a stock based on the belief that its historical prices will be replicated. You'll hear people saying, this stock once hit highs of 112 shillings, or this stock was 50 shillings in 2009. And therefore, they believe that because this happened once, it's just a matter of time before this occurs again. The mistake here is that the market conditions or business environment may be very different from what they were in that era, or even very different from what they were 1 year ago. Yes, it may occur that the stock hits such highs again, especially in a market like ours where quite a few stocks are undervalued. But there may be important reasons as to why the market is pricing that stock at that low price. Fundamental reasons like bad management, lack of innovation over a long period of time, new competition, or even a business model that doesn't reflect the current business environment. So never buy a stock just because it was once doing well. 4. Falling in love with your share. This mistake is quite common. Here are 3 ways to know if you're emotionally invested in your shares. 1. You're holding on based on a hunch or a hope, or even rumors that the price will rise rather than solid information. 2. There are 1 or 2 positives about the company and about 10 negatives, but you lean heavily on the 2 positive reasons to keep holding on and delay exiting. 3. You plainly ignore the fundamental problems or difficulties faced by the company. It's important to understand the business that you're buying into. What challenges has this company been facing? Does the business model make sense? Have they been making huge losses for a long period of time? If you don't understand the business, take the advice of investment advisors who do. Research houses like ours regularly give stock recommendations and outline whether a share is therefore a buy or a sell opportunity. Our research analysts sometimes spend months analyzing these companies before they give these stock recommendations. Unfortunately, it can be a temptation to many, including myself, to hold on to these companies, ignoring all the warning signs instead of cutting our losses. Yes, it can be painful to make a loss of 2 shillings per share, but it's even worse to hold on for too long and make a loss of 10 shillings per share. Waiting too long. This particular error goes both ways. It could be waiting for the very bottom where you buy the share just before the price begins to increase again, or it could be waiting for the very top so that you buy the share just at its peak. Investors in these particular situations are looking to book the maximum profit. There are 2 main ways that you could get caught in this error. One of them is that when the share price of the stocks you invested in begin to rise, your portfolio starts to look good. Today it's 10,000, tomorrow it's 20,000, the next day it's 30,000. The temptation for many investors is to hold on to these stocks for a long period of time, assuming that the share price will continue to increase. The temptation of holding on for just one more day. There are 2 problems here. One, you could wait too long and the next day the share price could take a turn and you lose your gains. And 2, these profits are just on paper. You don't actually realize them until you sell the stock and receive the cash. Or on the other hand, the share price has been dropping and you want to come into the market at the lowest possible price. So you wait and wait and wait before you enter the market and buy the shares. There's always the question of what if it's lower tomorrow? But what happens is the next day it could take a turn and you miss your opportunity. In summary, if the shares are doing well and you've made a good return, sell the shares and book your profit. And if the share price of a good company is falling, buy into the shares and don't wait for the elusive bottom. Too many people have missed opportunities like this. And those are the 5 deadly sins of stock market investing. We have great news. For the month of September, if you refer someone to AIB Digitrader, the #1 stock trading platform in Kenya, and they trade, you could win yourself 2 nights for 2 at Enashipai, one of the top destinations in Kenya, spa treatment included. Make sure someone opens an AIB Digitrader account through your referral code or link, and you stand a chance to win this amazing holiday. If you don't have an account, open one with us today and get referring.